Good morning, or good afternoon, or maybe good evening. Muy buenos dias, buenas tardes, buenas noches. I don't know when you're watching or listening to this presentation, but you are. And we are so very proud and honored and happy and grateful that you are with us. Welcome to Business 123 Introduction to Investments at Southwestern Community College. This will be our first semester where we will be using a new text, an open educational resources text, which means that it's free. uh, so please do check it out on wonderprofessor.com. You don't have to buy anything for the textbook. You can buy one of the previous textbooks if you want. And eventually, I think what's going to happen is that using the system we're using, Libre Texts, you can actually buy a copy for, I forget how much they charge you, but it's very minimal. But mostly people will just download it to their mobile device or their computer and read it there. My name is Frank Paiano, and I introduced myself somewhere else, so check that out. I am a professor emeritus, which is a fancy schmancy title, which means I retired from full-time teaching. I now teach part-time. Big deal. Plus the college gets to pay me less. I am in the School of Business and Technology, and I absolutely adore Southwestern. I've been there for a million years, and I hope to be there for a good many years more. The website is wonderprofessor.com. You probably already know that because you found the video. All the materials are on the website. All the link to the textbook is on the website. All the presentations and handouts and answer keys and commentaries. It's all there, and you probably are perusing that before you took a look at this. Maybe not. There will be a short video on that is a guide to the website, and some of you will be using Canvas, so you could also use Canvas. So welcome. Again, we are so proud and honored that you're here, and we are going to set a goal for ourselves. You have your own educational goals, and we're going to set a goal for ourselves. We want this to be the best class you have ever taken. I know it's a little over the top, but it is sincere. We want this class to be one of the few classes that 10, 20, 30 years from now, you can look back and say, you know what? That class actually did help me in this crazy, scary, absurd, joyful, sad, bizarre adventure that we call life. So let's get started. And we start with a perspective. It is a gloomy moment in history. Never has the future seemed so dark and incalculable. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. Of our troubles, no one can see the end. Did you see this last night on Skunk News? Weasel News? Badger News? Oh, right! Fox News, right! Where the evildoers in academia, in Hollywood, in those liberal... No, folks, it's not last night on Skunk News, Fox News. When you ask people when this was said, when this was written, they will often go back and say 1930s, Depression, or World War II, 1940s. Some might say 2001 with the attacks on the World Trade Towers. And you would know it's actually 1847 in Harper's Magazine, which was at the time a very influential publication. Did they have serious problems in the 1840s? Oh, yeah, they did. Yes. The nation was about to tear itself apart because of the peculiar institution. What a great name. Don't call it slavery, call it the peculiar institution. And yet, 200 years later, not quite 200 years later, look at where we are. Do we have serious issues, serious problems facing us in the 2020s? Yes, we do. But so far, equating serious with fatal has been incorrect. In fact, the last 200 years, the last 20 years, have been the most prosperous years in the history of the world. More people, as a percentage of the world's population, have come out of poverty than ever before. And I am firmly convinced, that doesn't mean I'm right, but I'm firmly convinced that the next 20, 30 years will be the most prosperous years ever, providing we don't blow ourselves up, die in our own waste, Ebola returns with a vengeance, and all the other pandemics that could occur, tsunami, earthquake, floods, fires, disco could return. Now, you maybe laugh, but you didn't live through the disco era, the 1970s. Yes, no, we have tremendous problems, but I am old and incredibly optimistic, if you can believe that. Usually as people get older, they get more and more pessimistic because of what is happening. The entire, almost, globe has decided, you know what? Capitalism might be the worst possible system ever devised, except for all the others. And so the standard of living around the world is rising. The educational system, educational knowledge around the world is rising. And because of that, we were able to create many, not just one, but many vaccines within a year to combat COVID. It usually takes 4, 5, 6, upwards of 10 years to create a vaccine. And yet, people all around the world, not just the United States, but not just Western Europe, but all around the world have created vaccines that are effective, nothing's perfect, that are relatively safe, and I'm very optimistic. So we'll see. Come back in 10, 20, 30 years, see if I was right. I'll probably be dead by then, but yeah, we'll see. Slide number 3. Here we are at Chapter 1. Introduction, Overview, and Risk versus Return. So in this catch-all chapter, we introduce the idea of investing and take a look at the investment universe. So we're going to learn a little bit about the various alternatives. And then we will discuss in detail risk versus return. Risk versus return. And you know what? Mr. J. Kenfield Morley said it over 100 and how many years ago. Best. Can't get any better than this. In investing money, the amount of interest you want should depend upon whether you want to eat well or sleep well. Yeah, we're going to come back to this idea of, do you want to eat well or do you want to sleep well? Over and over and over again, because we really do have to ask ourselves these questions. It would be nice if we had an investment that could allow us to eat well and sleep well, but they don't exist. However, we're going to learn how to eat reasonably well and sleep reasonably well. But as we will say over and over and over again, there ain't no guarantees, dear students. Slide number 4. What is an investment? You see, I think you've read it already, and maybe you've seen it heard it in other parts of this website and the like. But You do not need any prior experience to take this class. In fact, the less you know about investments, the better. The less you've been beaten over the head by your brother-in-law or uncle who self-appointedly says he's the best or she's the best investor the world has ever seen. Also knows everything about cooking and cars. And yeah, the less you've watched the talking heads on the internet or television, the better. Because we start from the very beginning and ask ourselves a very simple question. What is an investment? Well, here's there are a few different definitions depending on who you talk to, but here's the one we're going to use. An investment is any vehicle into which resources can be placed with the expectations that it will generate positive income or that its value will be preserved or increased or both. So we're looking for cash flow, income, or we're looking to increase the value or at least preserve the value, capital gains. So we will come back to these ideas over and over and over again. However, here's a much better definition from none other than Mr. Benjamin Graham, who is often called the father of value investing, wrote a wonderful book called The Intelligent Investor. Don't go out and read it right now. There's a couple other books you'd want to start with first. But he was Mr. Warren Buffett's teacher. And you've probably heard of Warren Buffett, the famed investor. And Mr. Buffett often credits Mr. Graham with his prowess. And he does a wonderful job of restating Benjamin Graham's timeless advice. And here's his definition of what an investment is. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. What does speculative mean? Well, we're going to use it often. We use it often in the world of investments. It's another word for gambling. We don't use the word gambling. Oh, no, that's such an ugly word. We say it's speculative. And so when you see speculative, what do you put? Yeah, put gambling there. And so Mr. Kenfield Morley used the word interest, but I would ask him, if he were alive today, to replace that with rewards or returns, because interest is just one type of investment reward. And so we see that investment returns come in the two different flavors we talked about: cash flow, income, interest, dividends, rent. And what are these things? Relax, we're going to go into them in more detail. But they're money that we receive from our investment. Obviously, interest is something you get from your savings account, but it's also what we get from what are called bonds. Dividends are like interest payments, but they come from stocks, from corporations. Rent is what we get from real estate. And we lump them under the term of cash flow. What's your cash flow on that investment? What is it bringing in the door? And then the one that most people key on is the capital gain, the capital appreciation, the increased value. Yippee! But we have to remember that investments go up and down in price, so we might have capital losses. Boo. So, make sure you understand our definition thoroughly. Any vehicle, which is a fancy word for an alternative choice, into which resources can be placed with the expectation that we will generate cash flow, positive income, or that we will have a capital gain, or at least not a loss over the long term. And we're going to spend some time now taking a look at the different characteristics that different investments have. We're going to mention several different examples. Don't worry if you don't know what they are. because we're going to come back to them. We're going to come back to them over and over and over again. So just key on the information that is presented to you, and don't worry about what you've learned or haven't learned or all the buzzwords you've heard. Just concentrate on what's in this presentation. By the way, I forgot to mention, and you will see it, the study guide. There's a study guide for every chapter. Make sure you print it out. I'm a bit old-fashioned. I like flashcards. I make flashcards, but of course you can make them on your phone now if you want. And study all the terms in the study guide, and there's a presentation commentary about the study guide and how to use it. So you might want to have that handy while you go through the presentation. So what are the types of investments? There are three types of investments with regard to the characterization of what actually the investment is. The first one, and the one that we will concentrate on, is called a security, securities. It's an unfortunate term because it makes people think of, law enforcement, administration of adjustments. But when you hear the term securities, you can substitute the term financial investments, okay? That's roughly equivalent. These are investments that represent debt or ownership or the legal right to acquire or sell. Don't worry about it. Just remember that securities represent debt. You're lending your money, or ownership. You're owning something, and they are financial investments. Property, on the other hand, is real property, which means land, buildings, or personal property, cars, gold, art collectibles. So we call these hard assets, whereas a security like a stock or a bond is, well, you used to get a piece of paper. You don't even get that anymore. It's in your account electronically. That's why we call these property assets hard assets or tangible assets. You might have heard the term commodity. And then the third type of investment here is personal investments. And these are often the best investments a person will ever make. Education, training, travel. Right. None other than Benjamin Franklin said that investment in one's own education and knowledge pays the best interest. I'm paraphrasing. I don't have the correct quote, but it's there. In fact, I think I'll sneak it into this presentation after I'm done here. How about that? So if you're looking at the presentation and listening to it, if you downloaded the file, it'll probably be there by that time, unless I forget. Okay, so we're going to concentrate on securities. And why is that? For the vast majority of us, they're going to be the investments that make the most sense for us, especially if we are working and we have a retirement account and the like. Now, many people will want to buy a home, and in that respect, it will be an investment. But in my humble opinion, it's a home first, an investment second. The real estate agents will tell you differently. And so for them, that would be their property investment. But the cool thing about a house is you get to live in it. You don't get to live in a bond or a stock. And then you're obviously very aware of how important personal investments are because you're taking this class. The other type of characterization that we have about investments are whether they are primary assets or derivative assets. Well, primary assets fall into two categories. You're either lending your money to somebody else, that's called debt, funds lent in exchange for interest and the promised repayment of the loan. We see that the big example of this is bonds, and we'll discuss bonds in detail. Well, first we'll discuss them not in detail, and then we'll discuss them in detail much later on. And savings accounts, short-term investments. Debt? Yeah, you're lending your money to the bank. The bank agrees to pay you some interest, and they promise to pay you back. The other type of primary asset is equity, which is a fancy word for ownership. When you buy a stock, you hear about stocks every darn day in the news, you're actually buying a piece of a business, a corporation. In fact, I don't like the term stock. I just wish they would use the term businesses, maybe corporations. But you're part owner. Or maybe you're buying property. You're the owner of that property. And so real estate is another example where you are buying into an equity position. Now, these derivatives, what are these darn things? Well, they are speculative. And what do we know about speculative? Right, gambling. They are securities that derive their value from an underlying security or asset. Huh? Wait a minute. They're not the asset? No, they are pointing to the asset, but they're not the asset. You don't understand. Don't worry about it. In the investment world, when you get to things that you can't even begin to understand, that's a good sign that you should stay away from them. And in the case of derivative assets, they are very dangerous. People are going to try to woo you into thinking you can make tons of money with these things. Make unbelievable amounts of money trading options and futures. Just take our $3,999 cost. 5 days guaranteed, you'll be right. Yeah, and they'll say you can make 100% overnight. They're right. You can make 100% overnight and then lose 100% the next day, which means you've lost everything when you lose 100%. So some people in the industry do not classify derivatives as investments. Yours truly, your humble instructor, is one of them. But that's all you need to know now, is that they derive their value from a different asset and that they're dangerous. And examples include options and futures, which are really called options contracts and futures contracts, but nobody says that because it's really hard to say 3 times fast. Slide number 7. Another characteristic that we will apply to investments is whether they are direct or indirect. Huh? Well, a direct investment is an investment where your name's on the title or the account. You're in charge. You can buy and sell the investment as you wish. Indirect investments, someone else is in control. You have limited control, or more likely no control over the underlying investment. Huh? That doesn't make any sense. Well, it does. When we get to it, we're going to find that mutual funds, which are very important choices for the vast majority of us, because when we go to get a job, there's going to be a employer-sponsored retirement plan like a 401k or a simple IRA, and mutual funds will be the investment choice of 99.99% of them. But in a mutual fund, you have no control over what's going on inside the mutual fund. That's for the mutual fund managers. Of course, it's your investment. You can sell it. You can get rid of it. You don't need it. But what's inside the investment, you're not in charge of. And the same thing is true for what are called Reits. Isn't that a great name? Reits. Real Estate Investment Trust. It's kind of like a mutual fund, but instead of stocks and bonds, they buy real estate. And then limited partnerships where the general partner is in charge of what's going on. The limited partner, you, the investor, you might have some say. You might, talk to the general partner and say, I think that's a great investment, or I don't think it's a good investment. But in general, you don't have any say of what's going on. Now, don't get confused. You can buy or sell your shares in the mutual fund, the REIT, or the limited partnership, but you don't control what's going on inside the investment. Now, the next category that we must key on here, and this is a slippery one, so be careful. It's subtle. Slide number 8. The domesticity, which is a fancy word for where do they get their mail. Where are they headquartered? There are 3 categories: domestic, international, and global. Whoa, wait a minute. I understand domestic. That's based inside the United States. What about this international and global part? Well, international is sometimes called foreign, or you might even hear the term overseas. Right. These are companies that are based outside the United States. So global is the combination, domestic and international. Global means all the world, todo el mundo, right? All the world. Whereas international means based outside the United States. So international, foreign, overseas is not the same as global. And it's important for you to be aware of this distinction, because you might wind up buying the wrong type of investment if you don't. The world is a very small place these days economically, said a very smart and now retired money manager with many years of experience. For example, Forbes says 65% by value of the parts in the Ford Mustang come from the United States and Canada, whereas 90% of the parts in the Toyota Sienna, which is built in Indiana, by the way, come from the United States and Canada, which is the more American car. How do you get more American than a Ford Mustang? Buy a Toyota Sienna. And many years ago, we're talking 50, 100 years ago, it was just assumed, and it was relatively true, that domestic investments based in the United States were more secure, less risky than investments based outside the United States, and of course, global somewhere in between, because you're mixing the two. But that's not true anymore. It's just not true anymore. Many companies and countries outside the United States have better accounting, more transparency than companies inside the United States. And it's not true anymore that all the best companies are based in the United States. Some are based outside the United States and are very good investments. And there are companies that are based outside the United States that do a majority of their business inside the United States and vice versa. I mean, there's a company called Coca-Cola. Maybe you've heard of them. They're based in Atlanta, Georgia. So they're a United States company. But they do 80% of their business outside the United States. So if every single United Stater decided that they were no longer going to drink fizzy sugar water with a brown crayon dipped in it, it would still be a huge company. It just happens to be that they get their mail in Atlanta. And then there is at least one company based in the United States that doesn't do any business at all inside the United States. They do all their business outside the United States. Philip Morris International. It's the company that sells the Marlboro cigarettes outside the United States. So as Mr. Ireland, Greg Ireland, said, the world is a very small place these days, economically. In fact, let's take a look on slide number 9 on all these companies. I'm sure you've heard of them all. Are they either domestic or are they foreign? Just scan, take a look, see which companies you think are domestic, which companies you think are foreign. Have you done it? You can pause it if you want to pause the presentation. So let's take a look at Budweiser. Mother Bud, right? Mother Bud. It's got to be an American company, right? Actually, not anymore. It's it's part of InBev, which is a Belgian, Brazilian, Mexican, South African conglomeration of beer producers. It's the same company that owns Corona and Stella Artois. I'm not trying to say that. Yeah, there was a big brouhaha when Budweiser was purchased by InBev. About 12, 14 years ago. Shell Oil, Royal Dutch Petroleum. Yeah, it's an Anglo Dutch company that is a country unto itself. They basically own Nigeria. And people would say, well, they have huge resources, huge in Houston. And you're right. But they're technically a foreign company. How about Ben & Jerry's, right? Can't get any more American than Vermont cows. No, it's actually owned by Unilever, even though Mr. Ben and Mr. Jerry are still very much in the news and very controversial at times. It's owned by a UK company that's, again, all around the world. Farmers Insurance, Zurich Insurance, based in Switzerland, now owns them. Arco is owned by British Petroleum. In fact, I don't know if you remember, this was about 10, 12 years ago. The sign, the Arco signs, the AM, PM, they started to say a BP company underneath it. So eventually the idea was that the Arco would disappear and BP would replace it. Because if you go on the East Coast, you'll see BP stations. But then we had the New Horizon disaster in the Gulf of Mexico, which was owned by British Petroleum, and all of a sudden the BP companies disappeared and just came back to Arco. Gerber Foods with the Gerber baby. What your little cutesy little baby is owned by Nestle. Carnation is also owned by Nestle. Cup of Soup is owned by Unilever. Now how about Fox Network? Come on. You don't watch Fox Network and you're not a real American. You are a communist because you don't watch Skunk News. I mean, Fox News. Fox News is actually based in Australia. It's News Corp, and Mr. Rupert Murdoch wants to own the world. Seagram's is based in Canada. Bayer is German. Vaseline is yet another Unilever product. Unilever is based in the UK. Friskies. Yeah, they're also owned by Nestle. Trader Joe's. Now, come on. Trader Joe, he's a good old guy. He goes surfing. He's gone. It's now owned by Aldi, which is a German company. And in fact, you can now find Aldis in the United States. So they're competing with one another. Now, 7-Eleven is a really interesting case study, you business folks. You go back, go and look. There's plenty of stuff on the internet. They get their own, Wikipedia site. 7-Eleven created a subsidiary in Japan. I forget, late 70s, early 80s. I forget when it actually happened. But it turns out that the Japanese love small stores. They just, we like big stores, big things, right? They love small stores. So 7-Eleven in Japan is kind of like grocery shopping. People there go there for everything. And they got so huge and so profitable, they turned around and bought the American 7-Eleven. So that's foreign too. I don't know if you've been in Mexico. 7-Eleven is making a very big push in Mexico because of the success of OXXO. Now, what about Volvo and Saab? Now, those were the two that you immediately picked up on and knew that they were foreign, right? Well, wrong. They're well, not anymore. For 20 years almost, Volvo was owned by Ford and Saab was owned by GM. But then the great financial crisis, the global financial crisis, 2008, the Great Recession, GM sold off Saab, Ford sold off Volvo, so now they're back to being foreign. In fact, the Saab car company, Saab has aerospace stuff that's still going to survive, but the car company's been defunct. And Volvo is now owned by Geely or Geely. It's a Chinese company that the Volvos are still built in Sweden, but they're going to be exporting. My understanding is Geely is going to be exporting a Volvo that is actually built in China. I don't know when that's going to happen. So the world is a very small place economically these days, dear students. Now, some people, let's talk about the politics. Some people get very upset when they see this, don't they? They get very upset. They think that the world, the United States is in decline. Wrong. This is a good sign. Why? You want the entire world competing and joining in the global economic global economy. Why? Because then you are partners with these people. And one of the things you don't like to do is bomb your customers and bomb your employers. And it just, I think, you can think what you will, but I'm excited. I am optimistic. We'll see. We'll see. Check back in 20, 30 years, see how it all turns out. Slide number 10. In fact, let's take a look. Here are the top 18 countries according to per capita income. Not the top 18 largest economies, no, but the top countries based on per capita income. Which country had the best average annual return over the past 40 years? Huh? What do you think? Who do you think it is? You can stop the presentation. But let's continue. It's Sweden, Netherlands, Denmark, Switzerland. Wait a minute. Those are communist, socialist countries that have universal health care and their students don't have to go into huge amount of debt to go to college? How? That just can't be true. Well, it is. Socialism has gotten a very bad rep for very good reasons, but there are situations where socialism is just a tool, just like capitalism. It's just a tool, but the way humans use it is determines whether it's good or bad. Is a hammer good? Is a hammer bad? Well, it depends. If you make a doghouse for your doggy, that's a good thing. If you hit somebody over the head, that's a bad thing. And it's true that socialism has very horrible consequences when used incorrectly, but in some cases it makes a whole lot of sense. Do you really want to have to compete for your fire departments? 3 different fire departments, who do I choose? Yeah, so sometimes it makes sense. But in general, even those socialist Northern European countries believe strongly in capitalism and the work ethic. So it's not an either or situation. It's use the right tool in the right situation. Now, what's going on with Japan and Spain and Italy? What's going on here? Why have they done so poorly compared to the rest of the industrialized world? Well, it's not that they don't have good companies. They do. Japan has some of the best companies in the world. It's the population, the demographics that we have to look at. It's very difficult to grow your economy when the number of people is shrinking, especially the workforce. The number of people in the workforce is shrinking, and the number of people getting old and retiring is growing. And so when you go to Japan or Italy, they will pay you to have babies. Now, the United States, we have grown our economy and our population mostly through immigration, throughout the 200 years plus of our existence. But that's a very sensitive topic. And countries like Japan, well, they just don't do immigration. So we'll see what happens in the future with our situation with immigration. As we said, it's a very touchy subject, very sensitive subject. But we'll come back to this ranking here. So it's not the end of the world, folks. It's not the end of our discussion about which country has the best average annual return over the past 40 years. Okay, next topic. Next topic is the time frame. Is it short term, intermediate term, and long term? Now I have just a little quick problem here. I sometimes see it written short dash term, intermediate dash term, and long dash term. And then sometimes you don't see the dash, you don't see the hyphen. So I'm a bit schizophrenic that sometimes I use it, sometimes I don't. I apologize if I'm consistent. I'm inconsistent, so I apologize. But I just don't. Sometimes I think, oh, I'll do it with the hyphen. Sometimes I say, no, I'll do it without the hyphen. So I should find all the places where they are and make them all the same, but I don't. So I'm a bit inconsistent in that respect. But still, it's more important is what are we talking about? Short-term investments, here are the general guidelines used throughout the industry. Up to a year or so. People say up to a year or so. Intermediate term, 2 to 5 years. 5 years or more is considered long-term. Now, this is very different from accounting. If you've taken accounting, they don't use the term short-term, intermediate term, long-term. They use current and long term. Current means a year, and anything more than a year is long term. Figure that one out. And then there are some disagreements, and I'm in the latter category. I disagree with these general terms. To me, short term is 1, 2, maybe up to 3 years. Intermediate, 3, 5, 6, or even 7 years. As you get older, your time frames get longer. And then to me, long term is 10, 20, 30 years. And by the way, these guidelines here are more along the lines of what the life insurance companies use. But the financial world, the investment companies, they use about a year for short term, 2, 3, 4 years for intermediate term, 5 or more for long term. Before you make an investment, you must know your time horizon. In fact, the time horizon is, in my humble opinion, the most important factor before you choose any type of investment. You got to know, okay, well, when are you going to need the money? Yeah. And then whether it is a liquid or an illiquid investment. Let's see now. Does that mean how much beer we have for the? No, not for the beer for the weekend. Liquid means that you can easily and quickly convert your investment into cash. There's a ready market to purchase the investment, and change of ownership happens quickly. So we're talking stocks, bonds, mutual funds, real estate investment trusts. These are all securities, financial investments, which all we have to do is go online, call our broker, and boom, there's somebody who wants to buy your 100 shares of Qualcomm. How about illiquid investments? Well, these are investments that are more difficult to convert into cash. The market for the investment is small, or the change of ownership happens slowly, or both. And the poster child for this category is real estate. You don't just sell your house and get the money next day. It doesn't happen like that. Now, during times of real estate exuberance, the mid-2000s and currently these days, real estate changes hands quickly. But normally it takes 3-6 months to sell a home. Partnerships, same deal. Sometimes it's very difficult to find somebody to buy your shares in the partnership. Collectibles, cars, art, it doesn't happen quickly. Okay, so liquid versus illiquid. And then the last series of attributes that will apply to different investments concerns the risk versus return, risk versus reward, the spectrum of risk versus return. Do you want to eat well or do you want to sleep well? Risk is the chance that actual investment returns will differ from the expected returns. Well, that's kind of a silly definition. We don't think of risk. We don't think of that when we think of risk. We think of the possibility of suffering harm or loss or danger. Well, you're right, but you can't easily measure that. We need something that we can measure. So in the investment world, we say risk is the chance that actual investment returns will differ from the expected returns. We can measure that. Not that it's going to help us that much in the future, other than to know that there's maybe a good chance that we ain't going to get what we thought we were going to get. And in general, the higher the expectation of investment returns, the higher the risk level. Do you want to eat well or do you want to sleep well? Now, these are my guidelines. You're going to see others in the industry. In fact, we really should even lower them even more. We should call this pre-2008, the global financial crisis, because since the global financial crisis, 12, 13 years now, it's gotten a lot lower. Low risk is not 3 to 5%. Low risk is 1 to 2%. If you're lucky. Some of them are paying a whole lot less than 1%. Moderate risk used to be 5 to 8%. Really, we should say, 3 to 4%, 5%. And then high risk, 6 to 8 or 9 or 10%. Anything greater than 10% should be considered speculative these days. But, again, the guidelines change over time, and this time period since the global financial crisis, the Great Recession, has been most unusual, and we'll see how it works out. So, 10, 12 period, 12 years seems like a long time, but again, it's just one period of time that we'll look back and say, well, that was an interesting period of time. We'll see. But make sure you've taken a look at the study guide and gotten all these terms that we've gone through, and go back over, watch the presentations, listen to presentations, take a look inside the textbook, because we're going to ask you to remember these, because you're going to be the investment guru. You're going to be the financial wizard for your friends and family and coworkers, colleagues. It's a very important and weighty responsibility. Because now let's take a look at some examples. Slide number 14. What type of investment is? So we got 6 examples here, huh? A Bank of America passbook savings account. We don't call them passbook savings. They used to give you, in fact, some people say that they still have these. They're credit unions mostly. It looked like a passport, but it was a passbook savings account. It's all electronic now. So you go to Bank of America and you get a savings account. What is it? Is it security or property? It's a financial investment. It's security. Is it debt or equity? Now, you might be tempted to say, it's equity, right? I own it. Well, no, it's debt. You've lent your money to Bank of America. They're going to pay you interest and then promise to repay the money. So it's actually debt. You're lending your money to somebody else. And that's an asset. Huh? It's a little tricky to think about, but it all makes sense. Yeah, I own that. I own that loan, and it is a debt loan. Is it direct or indirect? Your name is on the account, so it's direct. Is it domestic or foreign? Well, Bank of America used to be based in San Francisco. Now I think it's North Carolina. I'm not sure, but yes, it's still domestic. In short-term, intermediate, or long-term. We're going to see that savings accounts should be considered short-term. Some people look at them as intermediate and long-term investments, but in general, they're short-term investments. We're not going to gain much money, but at the same time, we're not going to lose our money. Is it low, moderate, or high risk? Very low. In fact, it's guaranteed. Right, exactly. So it's a low-risk investment. Is it liquid or illiquid? Very liquid. You go to Bank of America, say, I want my money, and they'll give it to you. Now, if you ask for it in cash, especially if it's in the tens of thousands or hundreds of thousands of dollars, they're going to look at you funny and say, well, we can give you a cashier's check, but they don't want to give you the cash. And if you demand the cash, they might say, you know what, come back tomorrow because we don't have it. And then they call the FBI. Oh, boy, that's the Patriot Act, because you might be a terrorist. How about Nestle Foods? Well, we've already talked about them, right? Is it a security or property? It's a financial investment. It's a security. It's a stock, right? Is it debt or equity? Stocks are equity. You're part owner. You are owning piece of the company. Is it direct or indirect? Well, it's direct. Why is that? On your account, it says your name. My name here, and you can do whatever you want. You can sell it. You can hold on to it. Is it domestic or foreign? Well, we've already said Nestle is a foreign company. It's based in Switzerland, but it's really a country unto itself. They're all over the world. No matter where you go in the world, there's maybe a couple places, but you can always find Nestle Foods. Short-term, intermediate term, or long-term? Well, in general, we consider stocks to be long-term. But in the case of Nestle, it's such a huge company. They're not going to go anywhere. Maybe we consider it intermediate term. We really should never consider stocks short-term investments because they could drop 20% in a week, a month, a day. It's happened in the past. It's going to happen in the future. How about low, moderate, or high risk? Well, in general, we want to think of stocks as high-risk investments because they are. But Nestle, moderate. Yeah, moderate. We could say moderate. Is it liquid or illiquid? Oh, yeah. Somebody wants to buy your 50 shares of Nestle. Now, what are these things? These Southwestern College Proposition AA and Proposition R bonds. What are these things? Well, these are bonds that Southwestern Community College has issued. We went to the voters of the South Bay and said, hey, we need to fix up the campus. We want to build that stadium and the arts center and all the other stuff. They're going to be building a kitchen for the culinary arts program. We need money. So we have to make loans, and that's what bonds are. Southwestern Community College issued bonds, which means we borrowed money and we promised to repay it, kind of like a mortgage. We promised to repay it over 30 years with interest. So is it a security or property? It's another type of security. A bond is a financial investment, a security. Debt or equity? It's debt. We're lending our money to Southwestern College. They're agreeing to pay us back the interest and the principal. Direct or indirect? Well, if you buy the bonds directly, they're in your account, then it is a direct investment. You can sell them whenever you want. You don't have to hang on to them until the mortgage is over, until the bond matures. You can sell them before that. You're in control. Domestic or foreign? Well, I know some people call us Tijuana Tech, but there is an Instituto Tecnológico de Tijuana, so no, we're still domestic here, folks. Short-term, intermediate term, or long-term? Well, most people buy bonds for the long term. They buy them for income, but yeah, you could think of it as an intermediate term investment because bonds are nowhere near as risky as stocks. They go up and down in value, as we'll see later on, but they're pretty secure. You don't normally want to buy bonds for the short term. Some people might, but they're not investors. They're traders. They're speculators. Low, moderate, or high risk? Well, the bonds are not based on the tuition that you pay for Southwestern College. They're based on property taxes that the owners of property in the South Bay pay every year, and that's how the bonds are paid. So in general, they're low to moderate. They're certainly not high risk, unless there's another global financial crisis. But no, they're fairly low risk, fairly moderate, not even moderate risk. I would say low. Liquid or illiquid? Bonds are very liquid, although it turns out that people usually don't trade them like they trade stocks. They hang on to them. They hold their bonds and hold on to them. But somebody's going to want to buy your bonds. If you want to sell your bonds, you don't have to hold on to them. You can. There's a ready market for them, just as there's a ready market for stocks. Now, what about this duplex in Spring Valley? You rent one, live in the other. Is that a security or is that right? It's our property. It's our real estate. Real meaning it's attached to the ground. Is it debt or equity? We own it. It's equity, right? Is it direct or indirect? Our name is on the title of the property down at the county admin building. So it's a direct investment. Domestic or foreign? Well, unless somebody takes over Spring Valley, it's a domestic investment. Short-term, intermediate term, or long-term? Well, real estate is one of those investments which, in my humble opinion, and many long-term oriented investors will tell you, you should always consider real estate long-term. I know there's television stations and television programs about flipping real estate, but don't do it. Maybe you might want to do it. Good luck, all I can say. Real estate should be considered a long-term investment, in my humble opinion. Low, moderate, or high risk? Well, at times, real estate can be very high risk. Real estate has a very high PETA factor, and I wish I would have come up with that term. That's Mr. David Chilton, who wrote the Wealthy Barber. PETA factor is pain in the factor, right? But once the real estate is set, once you have good renters and you've paid down the mortgage to a point where you actually are getting some kind of some cash flow coming in, real estate can be considered a moderate investment, but it never, you earn every dime, folks. Don't let people think that real estate's the easy investment. It's not. It's a lot of work. Liquid or illiquid? Well, during normal times, real estate is fairly illiquid. It takes 3, 6, 9 months. During the run up to the global financial crisis, you put the for sale sign up with Thursday, and by Saturday you had 5 offers, and Sunday you wrote the sales agreement. Then it sold in about 30 to 60 days after that. The transaction occurred 30 days, 45 days, or whatever. These days, we're seeing a repeat. We're seeing people put the for sale sign up on Thursday, and then by Saturday, they've gotten 20 offers. And so that's cycles. Is it all going to end in tears again? I don't know. I don't think so, but that doesn't mean I'm right. We'll see. How about Qualcomm? And supposedly it's all uppercase, but I can't stand writing it that way. It's a stadium. Well, not anymore. But what? No, it's a company based here in San Diego, but they make more money outside the United States than they do inside the United States. Right. Security or property? It's a stock, so it's a security. Debt or equity? It's equity. It's ownership. Direct or indirect? Well, your name's on the account, so it's a direct investment. Domestic or foreign? Well, here it's based in San Diego, but as we said, they make more money outside the United States. So, short-term, intermediate-term, long-term, stocks are considered long-term investments. I don't care what the people are telling you on you. Buy and sell, buy and sell. No. In this class, stocks are long-term investments. Low, moderate, or high risk? Fairly high risk, folks, especially the tech sector. Things change very, very quickly. Qualcomm was making still is making a ton of money selling the chips. They don't make the chips, by the way. They design them. Somebody else makes them for cell phones and tablets. And along comes Apple, and now they're making their own chips. And now, Qualcomm's a little nervous about that. Is it liquid or illiquid? Somebody wants to buy your 30 shares or 100 shares of Qualcomm. So don't worry. It's very, very liquid. Cool? Yes. And so now, given what you know already, you should be able to look at virtually any situation where we're exchanging money, usually, for some kind of vehicle that's going to either pay us income or have our value increased, or at least stay the same. And so let's take a look at a loan to Uncle Harry. Right. Every family has an Uncle Harry. Is it security or property? Well, it's a security. It's a loan, so it's debt. Direct or indirect? It's direct. You are the owner of the loan. Is it domestic or foreign? Well, Uncle Harry is domestic until you get a postcard from, I don't know, the Philippines or maybe Dubai. Short term, intermediate term, long term, or forever. Low, moderate, or high, or speculation. Is Uncle Harry actually going to pay? Oh, it doesn't look good for the home team, does it? And then liquid or illiquid? Very illiquid. Nobody's going to want to buy that loan from you and take over and then have Uncle Harry pay them. Cool. Now, what we want you to do is go back over and make sure you understand these terms and how they relate to one another. And again, we've thrown out the names of various investments. Don't worry if you don't know that much about them. You've heard the term stocks, probably heard the term bonds. What's this derivative stuff? Well, in our next presentation, we're now going to take a look at an overview of the investment universe. We will look at the various major categories of investment alternatives. We're going to take a 60, 50,000, 40,000. How high does a jet plane go? 40,000 foot view looking down upon the investment landscape. Study what's in this presentation. Study what's on this study guide, listen to it, read, watch it again, and be awesome. What do we say? It takes repetition. We discussed that in when hopefully you've read the syllabus, listened to the commentary on the syllabus. Learning takes repetition. So we wish you the best, dear students. As we've said, we want this to be the best presentation, the best class you've ever taken. So we'll see you on our next presentation with our overview of the investment universe. Are you excited? Oh, I know I am. And we want to thank you over and over again for being in our class. We are very grateful, honored, privileged, and happy. See ya.